Right now, ships are holding position at the Strait of Hormuz, one of the world's most important maritime choke points. When that passage is under threat, it doesn't stay a regional story. About 20 million barrels of oil a day move through this single strait. When tensions rise, it comes down to one thing: insurance. In conflict zones, vessels need a separate policy, war risk insurance. And before an insured ship transits an area like this, insurers may require additional war risk cover for that passage, which means the premium can jump fast. And that bill can climb into the hundreds of thousands, even millions, for a single transit. You don't need a military blockade to empty a strait. You just need the cost to close it. And we've seen what that looks like before. In late 2023, a few thousand kilometers away, the Red Sea went through the same shift. At the southern entrance to the Red Sea, the Bab el-Mandab Strait, a narrow stretch of water between Yemen and the Horn of Africa. Beginning that November, Yemen's Houthi movement started targeting commercial vessels passing through the corridor. The Houthis said the attacks were in solidarity with Gaza, aiming at ships they claimed were linked to Israel. They fired missiles at merchant ships entering the strait, boarded and seized a car carrier, and in early 2024, they hit the bulk carrier MV Ruby Mar, which later sank in the Red Sea. Naval patrols moved in after the first incidents, intercepting incoming drones and missiles and trying to keep the route safe. The strait was never officially closed. Ships could still transit, but within days, major carriers passed the Red Sea crossings, and others rerouted around Africa, adding 1 or 2 weeks to the voyage. So if the route was still open, why did the shipping world treat it like it wasn't? Because what changed wasn't the legal status of the water, but the level of risk. Once risk levels change, the market reacts. And that market reaction follows a pattern. After the first attacks, the industry hesitated, departures delayed, crossings reconsidered, decisions pushed back while people watched what would happen next. As incidents continued, hesitation turned into rerouting, and only after that did the naval presence really begin to scale up. But the shift that really changed how the industry treated the Red Sea didn't happen out on the water. It happened in London. The Joint War Committee is a London-based group tied to the marine insurance market. It maintains the listed areas map, the reference that tells the insurance market which waters are now treated as high risk. Once an area is listed, owners and brokers have to go back to insurance and arrange war risk cover each time the ship passes through. That's when the transit stops being routine. It has to be priced. And the moment insurers have to actively price that passage, normal shipping turns into a decision. Once that process kicks in, the conversation changes from "is the strait still open" to "what could go wrong here and what should the price of the risk be?" And to understand how that price appears, you need to know how a ship is actually insured. Because a cargo ship isn't covered by a single policy, it's covered by multiple layers of insurance, and war risk insurance is one of those layers. At the very base, you have hull and machinery. That's the ship itself, the hull, the engines, the equipment on board. If the vessel is damaged, this is the cover that pays for repairs. On top of that sits P&I, protection and indemnity, which covers the ship owner's liabilities, things like crew injuries, pollution, or damage to another vessel if there's an incident at sea. And separate from both of those is war risk insurance. It isn't included by default. It gets added when a ship is about to enter a listed high-risk area, like a zone flagged by the Joint War Committee, where the concern isn't an accident, but hostile action. That's where the process starts. Before the ship enters, the owner or broker goes to insurers for war risk cover for that passage. The insurer prices it, and the ship pays an additional premium, or AP. It's charged per passage, usually as a percentage of the ship's insured value, and it's written as a short-term cover, long enough to get through the listed area and out the other side. So if a ship's hull is insured for say $100 million and the AP for that transit is 1%, then the cost is $1 million. Not for the whole year, not for the whole fleet, but just for that one passage. And once that number starts to climb, routes that looked fine on paper can suddenly stop making sense. At this point, the choice stops being abstract because the ship owner is no longer asking what could go wrong, but something more practical. What are the risks on this route and what does it cost to accept them? Ships don't divert for one single reason. It's the pile-up, the threat, the risk of delay, and the possibility you end up waiting for escorts or clearances. And the longer you wait, the more the schedule breaks downstream. Missed port slots, missed connections, and real cost spreading through the supply chain. That's why insurance becomes decisive. When the additional premium jumps, it forces a simple question. Is this route still worth it? So it becomes a commercial decision. Do you pay the premium and accept the operational risk? Do you reroute or do you wait? Who pays depends on the contract. Sometimes it's the owner, sometimes it's the charterer, or it's built into the freight rate. Either way, someone has to approve the cost before the ship moves. And it's rarely one person deciding. Owners, operators, and their insurers are looking at the same numbers and the same trade-offs. If you reroute, in the case of the Red Sea, the alternative is going around Africa via the Cape of Good Hope. That choice costs you time, often 10 to 14 extra days, plus more fuel and more charter time. But it also gives you something that the Red Sea can't in that moment, a schedule you can actually plan around. Waiting is the third option, staying put for a day or two to see whatever the situation stabilizes before you commit a ship to a route you can't easily undo. Because nobody wants to be the person who bet wrong. And even then, the right choice can depend on what's on board. A container vessel with time-sensitive goods might still pay the premium, because arriving 10 days late can be more damaging than the insurance bill. But a bulk carrier hauling grain or coal can often absorb the longer route, because the commercial penalty of arriving late is usually lower. So the route didn't need to be officially closed for traffic to drop. It just needed to reach the point where the short route stopped being the default. And every voyage became a choice. Wait, reroute, or pay the premium and go through. And once enough companies make that choice, you don't need an announcement, you see it in the amount of traffic. In the first 2 months of 2024, Suez Canal trade was down about 50% compared to a year earlier. What makes that surprising is that this is also the moment naval protection was expanding. By mid-December, a US-led coalition was organizing protection for merchant shipping. In January came strikes against Houthi targets in Yemen, and by February, Europe launched its own defensive mission in the Red Sea. So if you're watching from the outside, it feels like it should be the turning point. Protection increases, the threat gets pushed back, and ships slowly start coming through again. But war risk rates don't move in sync with the military response. Navies can reduce the danger in the region, but insurers are praising the chance that the situation spikes again, not just whether the last few crossings went smoothly. So even as protection improves, insurers don't instantly treat the route as back to normal. They want to see that the change is real and lasting before the price comes down in a meaningful way. And that creates a gap. The route is still open, the naval presence is bigger than before, but the numbers still push companies toward the alternatives. So traffic doesn't return just because the protection arrives. It returns when insurance believes the risk has genuinely changed and price it that way. And that's the real takeaway. Once you understand that mechanism, you start seeing other choke points differently, including the Strait of Hormuz. With tension already rising, what matters is how fast that uncertainty turns into a price, and whether that price starts changing routes before anything official ever happens. Hormuz is the kind of choke point where the shift matters immediately. About 20 million barrels of oil a day move through this one narrow passage. So when uncertainty builds there, you don't need a blockade to feel the disruption. You just need enough ship owners and operators running their same calculations and deciding that the short way isn't worth it today. That's what the Red Sea showed so clearly. The route stayed technically open, naval protection expanded, and yet traffic still fell. Because what decides that route in practice is whether the voyage is still something you can plan around and pay for. So when you hear the strait is still open, don't imagine business as usual. Watch the pricing, because that's the moment the map starts changing. Ships reroute, schedules slip, and the lane quietly empties out. Not because anyone shut the strait, because the market didn't need to close it. It just had to price it out.